Hello, passive investors. If you're interested in real estate but have never considered syndication investing, we've made this episode just for you. We're starting at the beginning. It's the 101 on syndications and who should invest in them. Hello and welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeifer. I'm joined today by Devon Kennard, who invests in all types of deals but really specializes in passive strategies like syndications. Devon and I are going to explain what syndications are, define some of the terms you'll hear if you start exploring them, and talk about the advantages and disadvantages of syndication investing at a high level. If you've never considered investing in a syndication, I think you'll learn a lot from this conversation. If you're an experienced investor, don't fret. There's plenty in this episode for you too, especially a phenomenal tip Devon shares with us about vetting the sponsor. Let's get into it with Devon. Devon, thanks for joining the show. Let's get a brief history of you and your investing journey to start out for those who might not have heard you on other Bigger Pockets podcasts yet.
My name is Devon Kennard. I retired from the NFL at the beginning of 2023. So 2022 was my last season. So just about 2 years now. Started investing right after my rookie season in the NFL. Bought my first single family property. Recently published my book that's right behind me, Real Estate Side Hustle. But I kind of consider myself a professional passive investor. Every strategy I've considered investing in, I needed to do it in a passive way because I was busy trying to sack Tom Brady and Aaron Rodgers, not worried about real estate. So I started out with single family properties and I was buying turnkey, and then that turned into some value add stuff, but I wasn't scaling fast enough. So I started leaning heavily into syndications, and I have a large portfolio of syndication investments. And most recently I got into private lending, and I own my own private lending company. And I would say those are my three main buckets today. My own personal portfolio of properties, a large section of portfolio of investments and syndications, and then the lending. And they all kind of serve different purposes for me. It's just something I've been building up over the last decade.
That's awesome. So how did you find syndications? Because in this show, as you know, we're going to be talking about specifically syndications and kind of an introduction, 101 is to say about syndications. But how did you find them?
I originally got into syndications because I met a financial advisor, which he's not really, he's more like a consultant. All he did was underwrite syndications across the country. He kind of specialized in it. So I got connected with him and learning about it. And at the time when I was in the NFL, a lot of people weren't investing in syndications or funds or anything like that. So it kind of sounded untrue to me. This is too good to be true. You're talking about 15 to 20% IRRs and all this stuff. But the more I kept learning about it, the more it made sense to me and seemed like a better alternative than what I was doing and the exposure I knew a lot of my teammates were having in the stock market, and then what I was trying to do in single family properties. I related to playing football. If I showed you my playbook, it'll look like hieroglyphics to a lot of people. And that's how syndications could look. You hear terms like PPMs and subscription agreements and IRR and cap rate. All you got to do is learn the basic terminologies, and then the game starts to slow down a little bit, and you start to be like, okay, I can wrap my head around what this is. And, I hope we can help people with that today.
That's a great way to frame it. So let's dig in, right? So you mentioned a fund and you mentioned syndication. Can you explain what those terms are?
Yeah. So a syndication is essentially, it could be an individual or a group of people. So let's say, for example case, it's me and you. We're the general partners. And all that means is we're the people doing the work. We're finding the deal, raising the capital. We're deciding what the budget's going to be. We're putting the loan in our name or our company name. So we're really running the deal. But the deal is too large for us to handle by ourselves. So we go to a lawyer and we create a syndication and get all the documents, and we could get into the documents if you want. There's a couple of different documents you have to have. And then we go to investors, typically accredited investors, and say, hey, look, we're investing in multifamily. This deal is 100 units, and me and Jim can't afford to buy this deal by ourselves. So we're raising capital from people like yourself. Do you want to invest in this deal? When they say yes, that's essentially locking into they are the limited partners and we are the general partners, and we control everything with the deal, and the limited partners underwrite us. So they look at us and say, okay, do I believe in Devon and Jim? They look at the deal. Do I believe in the deal, in the projections they're making, in their plan and their business plan for it? And if they do, they invest, and we're kind of off and running. So that's kind of the basics of what a syndication is. And a fund is similar, but a little different in that we would be coming to them almost like a theory or an idea of the type of properties. Like, hey, we're going to buy 100-unit apartment complexes. I'm in Arizona. So let's say in the Phoenix, Arizona market, we want 90s built, and we're going to kind of have our like box of what we're telling them we're going to buy, but we don't have any properties yet. So as the limited partners in this case don't really have the opportunity to invest the individual deal. So investing us in our buy box essentially is really important, because then we raise that money and we can go and find 2 or 3 different 100 unit apartment complexes. So there's pluses and minuses. Some people like funds because it allows you to diversify a little bit between multiple properties. Some people like syndications because they really get to underwrite that one deal and the investment is for that one property. So there's give or take from both, but they're similar with that little kind of difference.
Okay, and you mentioned accredited investors. So I just want to pause real quick and say an accredited investor is someone that makes $200,000 if they're filing single, or $300,000 filing jointly, or has $1 million in assets outside of their the home that they live in. And you mentioned most of these are targeted towards accredited, and that is completely true. The non-accredited have to work a lot harder to find deals that they can invest in, because we're not going to get into the weeds on this, but there's deals that accredited investors can invest in, and there's deals that accredited and non-accredited can invest in. So you can be either, but it's a lot easier if you're accredited. You also mentioned documents. So can you tell us just the basics? What documents are we looking at in a typical syndication, or should we look at?
You can correct me if I'm wrong, but the 3 main documents I usually get as an LP is the operating agreement. So in the example where if me and you were the GPs, we would be creating an operating agreement with the lawyer, kind of outlining whose responsibilities what, how stuff's going to be divided between GPs and LPs, all of that kind of stuff. So there's the operating agreement, the subscription agreement, and then the private placement memorandum. So those are like kind of the 3 main documents that you're going to see. And then there's decks and pro formas, and there's other information you can get. But, expect those 3 documents and really grow to understand and get comfortable in reviewing those documents.
Yeah, absolutely. It's super important. And just for a little context, the operating agreement, this is an LLC. As Devon said, there's GPs and LPs, but we are all members of the LLC, which is a limited liability company, which is an actual company. So you are going into business. If you're an LP investing, you're going into business with these GPs. And Devon's going to talk a little bit later about how to vet the operators, but we just want to make sure everyone understands that's why you review all these documents, right? You're going into business with somebody.
Absolutely.
So let's talk about main advantages of investing in the syndication. You talked about, you had some single family homes, you're maybe doing some turnkey stuff, and then you found syndications. What are the advantages? Why did you decide to invest in syndications rather than some of the other real estate opportunities?
It's much easier to scale. So, when I started buying off single family homes, I wanted to grow a portfolio large enough to reach some of the goals that I had. It was challenging to get there when I was so busy buying my own properties. So syndications allows you to scale a lot faster in investments and reach certain financial, goals you may have. And then the passivity level, to where most of the work, if you're investing in syndications, is up front. You have to underwrite the operator, underwrite the deal, look at those 3 documents we just went over. Once you do that, it's pretty much just rinse and repeat, in the sense of you're going to get monthly, quarterly, annually, depending on how, the GPs give out information, but you review their statements and the reports that they give out. And that's really all you have to do. That passivity and then allowing you to scale is a big thing. And then the diversification. So, all right, I started out buying single family homes in the Midwest. When I first started investing, I didn't necessarily want to buy in Arizona because I thought it was too expensive, or New York or whatever. Well, if I'm not doing that myself, I can invest in a syndication that invests in those areas. There's single family syndications, multifamily, office buildings. So there's all kinds of time. So you get to diversify in asset class and location. That's hard to do on your own. So I think that diversification piece is a big one. And then although you're doing this, you still get a lot of the tax benefits of buying a property on your own. You get to participate in depreciation and all of those type of things. You get K1s that will show losses a lot of the times if the GPs are structuring it that way. So yeah, there's a lot of advantages to investing in a syndication because of that.
Yeah, that's well said. I think the diversification is one of the big ones. Like I started in just buying my own properties, but then you're kind of committed to a local area and you're committed to residential, most likely, right? and you're committed to one operator, which is yourself. The way I look at it, and a lot of it when we talk in passive pockets is, we're talking about diversifying by asset classes, you mentioned, because there's a lot of different asset classes, by market, and then also by operator. So you have different operators, and also by strategy. Right? There's a lot of different ways to diversify, and it's a lot tougher to do that, I think, when you're managing it yourself. And you also mentioned tax benefits. I don't know what your experience is, but my experience was we don't want to get in the weeds too much on this episode, but there's a thing called cost segregation, which allows you to get something called bonus depreciation, which gives you more depreciation up front so you can use it faster. And it's a lot easier to do that through a syndication than like a single family home. So my tax part of this, the tax benefits that I had, were probably better in this syndication investing than in my single family and other investing. And as I always say, the taxes are probably the biggest eroder of your wealth. So did you find that as well as far as the tax situation? Were you getting better tax benefits in syndications than you were on your own stuff?
Oh yeah, absolutely. And it was kind of easier. You didn't have to go through a cost seg on your own and, do all this stuff. You're really just getting your K-1 documents and getting on the same page with your accountant. So I feel like that's a huge plus for sure.
Yeah, and you mentioned a K-1, and again, I'm trying to make this really basic, so I'm just going to say K-1 is a tax document that you receive from an LLC when you invest in it. Come April 15th, hopefully by March 15th, actually, they send you a document that's a K-1, and that basically just shows you how much you've invested, with how much depreciation there is, so how much paper loss you can take, and then how much money you made, distributions or otherwise, on the property. Devon, I don't know how you do it, but I just review it, and then I toss it off to my accountant.
Absolutely. And, I kind of dumb it down with the K1s too. Like almost any investment, or if you're at your W-2 job, whatever, there's some kind of documents that you have to give to your accountant based on your salary or the investment. So the K1 is just a document for the syndications. Like if you invest in a syndication or fund, you're going to get a K1. That's the document you need to kind of track your investment accounting wise. So sometimes people get overwhelmed because they haven't heard of that. And it's like, oh, what's this new tax document? And it's no different than anything else you have to do for any other aspect when it comes to generating income or investments, but you'll get used to and comfortable with that as well.
Yes, and so will your accountant. So we're talking about syndication investing. Who might this strategy be appealing to? I think there's a few different types of people who get into this. I don't think it's super appealing to somebody, young person who's just getting their start and doesn't have any capital, right? But who is it appealing to?
I think it's appealing to anyone with capital to invest that wants to make additional income passively and wants some tax benefits, because there's a lot of there's syndications you can get into that are more cash flow heavy. There's syndications you can get into that hopefully are going to 5X within, 5 or 10 years. Like there's different strategies. So, I think they can, really appeal to just about anyone besides the person probably just starting out, because you're essentially going to invest your money. And in the most case, what I've seen is most syndications are anywhere from 3 to 7 years. So let's say an average of 5 years. And if you're trying to build wealth, that's a long time to just have money gone, not making anything on. But if you're someone who has some money that they can invest and, reap the benefits along the way, but don't need that money back anytime soon, like I think a lot of different people fit in that category, and there's great benefits there.
When I look at it, I think there's a few different markets or types of people. There's people like you, right? You were a high wage earner who have cash and need to deploy it. And also you probably didn't have a whole lot of time when you were in the NFL to do all this work to be an active investor. So passive was a great strategy. It's also for, people who have maybe done the single family thing and bought 20, 30 properties, and now they really like the real estate, but man, they don't like all the tenants and all the things you have to deal with as an owner of a property. So maybe they go on and become a passive investor. And I think there's some that might only have a couple of properties, but are building wealth and are like, wait a second, maybe I can do a little bit of both. So I think there's a lot of different types of people this is for. And the thing I would like to communicate is it helps to have a lot of capital, but you don't have to be wealthy. This is a great way to build wealth, and there are ways to get in at smaller dollar amounts, group investing and other things, but it is targeted to people who have capital, like you said, Devon. I want to jump into the disadvantages, right? Every investment strategy or type of investment has advantages, hopefully, but they all certainly have some disadvantages. So it's not always the right fit for every investor, but what are some downsides you see to syndication investing?
I would say a couple. Number one is the illiquidity. So typically, it's going to be like pulling teeth if you want to get your money out earlier. Some general partners or syndicators might let you out, but for the most part, when you invest, you got to assume that your money is going to be locked up until it is returned. They sell the property, refinance, what have you. So you're kind of stuck. It's locked up. Another disadvantage is that just you have to really trust the operator and their business model and their decision making as things start to evolve and change. You have very little to no control over any decisions. So if you make the wrong decision, your money's locked up and you're just kind of sitting and waiting and hoping that they, know how to solve problems and can make the deal profitable. So those are the, two that stick out the most and can be detrimental. Is if you put $200,000 in and something happens in your life and you need that money back, you can't assume you're just going to be able to get it back. Now, if they're successful enough, they might let you out, replace you with another investor, but they by no means, and any of the ones I'm in at least, are guaranteeing that they will do that.
And that's one of the things that it took me a while to figure out. Like, I knew they were illiquid, but I didn't really realize they were illiquid until I put, a lot of capital in, and then the market changed, right? So deals weren't turning over because it was, you said average of 5 years, which is true. In the good times a few years ago, it was really more like 3 years, or sometimes 18 months. And so I was just assuming that would go on forever. And then I realized when the market changed, I had a bunch of capital tied up. And if I wanted to do anything, I didn't have any liquid capital. So that's something to think about. And I do want to add one more disadvantage, or something to think about, I guess, less a disadvantage. And that's the K1. We talked about it earlier. I don't know about you, Devon, but my last K1 came in October, which was very disappointing. And I would tell people, if you're going to invest this way, it is likely that you might have to extend your tax returns and not file on April 15th, which doesn't cost you anything, and that's okay. But, waiting until October, the last deadline's October 15th, that gets a little bit crazy. So when did you get your last K1?
I'm in the same boat. I probably got it at the very end of September, and I'm to the point, I have over 40 syndication investments, and I'm to the point where I feel like I'm filing taxes year round, because I just officially filed, like we filed on October 15th for all of my stuff. I have a meeting with my accountants next month to talk about this year, 2024. So it's like, you almost don't get a break. So I would say that's a disadvantage, to where, most people are like, oh, I can't wait till April 15th to get this over with. Don't think about it for a while. I'm low-key thinking about taxes and accounting and filing and all that year round. So that's definitely a disadvantage.
Okay, so all of this sounds pretty good, right? This syndication investing, even though we just went over the disadvantages, they're not anything that stops me. So when you're thinking about finding the syndication to invest in, what steps should you take? Can you talk about maybe the roles of the GPs and LPs to start, and then we'll dig in after that.
Understanding the roles of the GPs and the LPs, and that the GPs are controlling the deal and what their responsibility is, how often they're going to be communicating with you. But it really comes down to being able to underwrite the GPs. Do you believe in their ability to execute their plan? Do you believe in their plan? Do you believe in their underwriting? And then does the actual deal make sense? And that's the magic sauce, essentially, because that's all you can control. Once you send them your money, you're pretty much stuck. So it's like all of your work has to be upfront in understanding the GPs, their business model and their plan, and then the deal. Unfortunately, a lot of people are, I say the tide's going back, and you're starting to see who's naked when it comes to general partners, because over the last 10 years, you could throw a dart at the wall and people are hitting, in the sense of they're making money, they're looking good, they're looking like the smartest people in the world. But now over the last year or two, that's starting to not be the case, because interest rates and cap rate compression, which is pretty much just like they were predicting that cap rates were going to go down and things were just going to be going great, and it didn't play out that way. So deals aren't working out. So now there's a lot of general partners who are in positions where they're asking their investors for more money. And this isn't to scare any of the listeners, but there's a real side of this, to where making sure you invest into the right deals with the right general partners, that's a really important component, and something that I'm glad everyone listening has passive pockets now, because when I was first taught this, I was starting to get pitched syndications, and if I didn't have a mentor and a consultant that was helping me understand how he was evaluating the deals. When you look at those documents we discussed and the pro formas and the underwriting, they make it look pretty. Like they're hiring some top level people to put these presentations together to where you think you're about to make $1 million and you're going to be the richest person in the world. So you have to kind of look behind the curtain and see what's really going on.
Thanks for mentioning passive pockets, because I think the number one thing that you need as a passive investor is a community. And again, I'm biased. I think passive pockets is the best community. But if it's not passive pockets, find another one, because it's conversations with other LPs like Devon that really help you learn a lot. And then I also want to back up. You mentioned cap rates, and this is one of the most confusing things to me and many investors. But when cap rates go down, right, that means values are going up. So if you're an owner of a property and you want to sell it, cap rates going down sounds like a bad thing, but it's actually a good thing for the seller. So just something to think about. And then you also mentioned you got to vet the operator. And we had a great session in Cancun at BPCon where you and I and Chris Lopez kind of talked about the things we most look in an operator when we're trying to vet them. So can you talk about some of the vetting you do for an operator, what questions you might ask, and then what are the things that are most important to you?
One thing I like looking out for right off the bat is I want to know what their track record is. If they've only been in the game for a couple of years, if they're new, if they haven't had any deals fully mature yet, if every deal they've done has just been a home run because it's been in the last couple of years, that doesn't mean I won't invest, but that's cause for hesitation for me, because how's that going to actually play out? Have they gone through adversity? Have they navigated, interest rates going up? How are they going to exit now that interest rates did go up and they were up for so long? And, now they're starting to go down, but they're still higher than what they expected. So I'm really kind of paying attention to that and how that their current deals are going. So now if they're raising funds for their next syndication, well, how are the deals you have outstanding going? How are they performing? How have you performed over the last 10, 15, 20 years? I would love to see a general partner that's been in the game 20 to 30 years. He's been doing multifamily in the Midwest for 20 years. He's navigated that space for a while. Things aren't great. He's acknowledging that with his most recent stuff, but the sky isn't falling. They're going to get through it. That's the conversations that I'm loving right now, and not the other way around to where, they've been in business for 5 to 10 years. They've had a couple of great exits, but the deals right now aren't going too well, but they're really confident in this next deal. So right off the bat, track record, but I had to kind of dive into track record a little bit, because before you could just be like, what have they done in the last couple of years? And you got to kind of really dig a little deeper now in that track record. How long have they really been doing it? What have their exits look like? And how are their current portfolio doing? So, I would start there.
And you mentioned track record, and this is something I've been going back and forth with, because you have experience and you have track record. And you said it, before a couple of years ago, everything just went up. So track records for everybody were great. And the experience didn't really matter because track records were fantastic. So now when I look at it, anybody that we're investing with now that's been at least, operating for the last couple of years, they have a track record through tough times. So is it going to be easier to vet operators now because they've been through a tough time and you can see how they did? Or because they've been through this tough time, does that mean that it's just easier to just say, no, I'm not going to invest with them? Have you thought about that at all?
I think it's going to make it easier in the sense of I'm going to put a lot of onus on how they're handling the current market and how their portfolio is managing right now. Some of the best GPs that I know, they weren't buying some deals the last couple of years because they saw some of this coming, or they were being overly conservative. So they're like licking their chops right now because they think more and more opportunities are going to be coming up because of distressed situations from other general partners. So when I'm hearing conversations like that and seeing a portfolio of in track record from a GP, that is encouraging, and that's something that I'm going to consider. So I think that's a good thing, because now this troubling time, what happened for you between 2021 and 2024? Did you have any deals outstanding? What did that go like? What did that process? I'm going to be focused on that, because I want to know, did you prepare at all? And everyone was blindsided to a degree because interest rates went up. But at the end of the day, there's some people who are still in business and their deals are okay. and it's not as great as they thought, but they're okay. And they're going to, we're going to get through this and we're excited. And there's some people who are holding on for dear life right now, or they're kicking the can down the road, but they're going to lose all the investors' money one way or another. Quite frankly, those are the deals I won't be investing in, or in the general partners I won't be working with in the future.
And you mentioned, getting through this time. One of the things that's most important to me when I vet an operator, and all of these things are important, right? But communication. So I want to know, how do you communicate once a deal is in place, right? And especially through the downtimes, I want to know about things that are going poorly before they happen, as they're happening, not right before you issue a capital call or something like that. So for me, communication is one of the most important things. And we talked about this when we did our session at BPCon. And, we each had different things that were important to us. But when you're talking or Chris was talking, I was nodding my head the whole time, like, yep, those are things that I look at too. So it's important to have a comprehensive idea of how to vet an operator. And that's one of the things, again, you mentioned it, but a community like Passive Pockets really helps with that.